Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 3-1 question number 2. This is the structured paper 3 which consists of 3 questions. All of them will be of 25 marks and the total time limit given for this paper will be 1 hour and 30 minutes, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question under 30 minutes. So without any further delay, let's get started. The directors of Z PLC provided the following information. For the year ended 31st December 2022, we're given information regarding revenue, and we're told that all of the revenue are on credit, and we're also given information regarding purchases, and we're also told that all of the purchases are on credit. Then we're also given non-current asset turnover. So let's go through all of these ratios and figure out the remaining values as well. So for non-current assets turnover, remember that our formula is just the revenue divided by the total non-current assets. And this is the net book value of non-current assets. Now we already have revenue to be 825,000, and we're also given that the non-current asset turnover is 1.6 times. So we can just figure out the value for net book value of our non-current assets. Let's do that. So we have 1.6 equals to 825,000 divided by the non-current assets. This means that the value of non-current asset will be equal to 825,000 divided by 1.6, which results in the value of 515,625. Alright, then we're also given interim dividend paid. This is the rate per share, and we're also given the final dividend proposed. Again, this is the rate per share. Then we're given gross profit margin to be 48%. Alright, so what this means is that out of revenue, 48% of it will be our gross profit, whereas the remaining 52% will be our cost of sales. Let's calculate these two values. So for gross profit, we will just start with our revenue. That's 825,000. And 48% of it will be our gross profit. So we're just going to multiply it by 48%. And this results in our gross profit to have the value of 396,000. We repeat the same process for cost of sales. We start with our revenue of 825,000, then multiply it by the rate of 52%. This gives our cost of sales to have the value of 429,000. Okay, then we're given dividend yield, and dividend yield has a value of 4%. Now again, we need to work with the formula for dividend yield, and the formula is just dividend yield equals to dividend paid plus dividend proposed, and these are just going to be the rate per share, and we divide it by the market price per share. Okay, we're given the value for dividend yield right here, that's 4%, and we also need to multiply it by 100% because the ratio is in terms of percentage. Then we're also given information regarding interim dividend paid and final dividend proposed. So we need to write these two rates in our numerator. So that will be 0.30 plus 0.15 divided by our market price per share multiplied by 100%. Now we can easily solve for the market price per share. That is just going to be equal to 0.30 plus 0.15 divided by 4 multiplied by 100, because we can just cancel the percentage signs on both sides. And this gives our market price per share to have the value of 11.25. Okay, then we are also given the price earnings ratio to be 18. Again, we are going to utilize the formula for price earnings ratio. Okay, so we have price earnings ratio, and the formula is just going to be market price per share divided by earnings per share. In this case, we have already figured out the market price per share, so we will be trying to figure out our earnings per share with the help of the price earnings ratio. So the ratio is 18. We figured out our market price per share to be 11.25 divided by earnings per share. Now we can easily figure out the value for earnings per share. That is just going to be 11.25 divided by 18, which results in the value of 0.625. All right, that's all for the given ratios. Now, we're given additional information as well at 31st December 2022. So we're given the inventory. This means that 44,000 is our closing inventory for the year. We're given the closing trade receivables, trade payables, cash at bank, 6% debenture, which will be our non-current liability. And we're also given ordinary share capital and share premium, which will be part of our equity. Okay, let's move towards our first question. We need to state two comparisons which a business may make by using ratios to assess its performance. So the very first comparison that a business may make by using ratios is by comparing our company's ratios to that of our industry average. Let's write it down. And this helps figure out where our company stands within the industry. The next thing is intercompany comparison. We can also compare our ratios with that of competitors' ratios. So that will be our intercompany comparison. All right, that's all for the first part of this question. Let's move towards the second one. For the first part, we need to calculate net assets at 31st December 2022. We first need to understand what is meant by net assets. So this is just the difference between all of our assets and our liabilities. So we basically have to subtract all of our liabilities from the assets in order to figure out the value for net assets. So that's quite easy. Let's have a look above. So we were given inventory. This is an asset. We're given trade receivables. This is also an asset. We're given trade payables. This is a liability. We're given cash at bank. This is an asset. We're given 6% debenture, which is also a liability. And these two are part of our equity. So we do not need to include these two while calculating our net assets. And also remember that we calculated the value for our non-current assets with the help of our non-current asset turnover ratio. So we also need to include this value under our asset. All right, let's write it down. So that's 515,625 plus 44,000 plus 76,400 plus 81,000. That will be our assets. Okay, so that's going to be 515,625 for the non-current asset. Then we add 44,000 for our inventory. Then we had 76,400 for our trade receivables. And then we also had 81,000 for cash at bank. Now let's move on to our liabilities. So we have 32,900 and 100,000. That's all for the liabilities. So that will be minus 32,900 minus 100,000. And this gives the value for our net assets to be 584,125. All right, let's move to the second part. We need to calculate retained earnings at 31st December 2022. So remember that retained earnings is a part of our equity, right? And we also know the formula that assets will be equal to our equity or capital plus our liabilities. All right, we can just bring the liability to this side. So that will get us assets minus liabilities will be equal to equity. Now remember that assets minus liability is just the value for our net assets, which we have already calculated for in the first part. So we can just substitute it with the value of 584,125. And then for equity, we were given our ordinary share. We were also given the share premium. And we know that the retained earnings is also part of the equity. All right. Now we can just substitute the values for ordinary share capital and share premium from the value given above at the date of 31st December 2022. So the values were 300,000 and 30,000. We're just going to write it down. Now we can easily figure out the value for retained earnings. That is just going to be 584,125 minus 300,000 minus 30,000. And this gives the value for retained earnings to be 254,125. That's all for the second part. Let's move towards the third one. Now we need to calculate retained earnings at 1st January 2022. So for this, It will be easier if you remember the format for our statement of changes in equity, but only for the retained earnings column. So remember that we start with our opening balance, so that is balance BD. Then we add all of the profit for the year. Then we need to subtract our dividends paid. And then we also need to subtract for transfer to the general reserve. And this will give the value at the closing date. So that will be our balance CD. Now in this case, we're trying to figure out the balance at 1st January 2022, which is our opening balance. So we're trying to figure this out. Now let's add our profit for the year. Okay. In this case, we're not actually given the profit for the year, but we already figured out our earnings per share. And now we'll evaluate profit for the year using the formula for earnings per share. The formula is just the profit for the year divided by the number of ordinary shares. We're already given the value for our ordinary shares, and we also know that the nominal rate is 1 per share. So we can easily figure out the number of shares. That is just going to be the value of 300,000 divided by the nominal rate. In this case, it's 1, which means that our value will be equal to the number of shares. Alright, now we have already calculated our earnings per share to be 0.625. We're trying to figure out our profit for the year, and we also know that the number of ordinary share is 300,000. Now we can easily figure out the profit for the year. That will just be equal to 0.625 multiplied by 300,000. And this gives our profit for the year to have the value of 187,500. So let's write it down. That's 187,500. Now we need to subtract the dividends paid. Okay. In this case, remember that we are only subtracting the dividends paid and not the dividends proposed. So we only need to consider the rate of 0.30 since this is the dividend paid. Alright, we need to figure out the total dividend. And remember that the formula for total dividend is just the rate per share, which is in this case is 0.30 multiplied by the number of shares, which we have already figured out to be 300,000. And this gives the dividend paid amount to be 90,000. We need to subtract this. So that's 90,000. And we are not given anything regarding transfer to general reserve, so we just assume it to be 0. Now, this will be equal to our closing balance, which you already figured out before. Right here, that's 254,125. So we can easily figure out the opening balance for our retained earnings. This is just going to be 254,125 minus 187,500 plus 90,000. Which results in the value of 156,625. Alright, that's all for the third part. Let's move towards the next question. Now we need to calculate the following at 31st December 2022. The first one is working capital cycle. We need to round each component up to the next whole day. Okay, so remember that the formula for working capital cycle is just our trade receivable turnover. And all of these will be the turnover in days. So we start with trade receivable turnover. Then we add our inventory turnover. Then we just need to subtract our trade payable turnover. Okay, so you need to show your workings right here, but I'm just going to calculate all of these three figures above. Okay, we first start with our trade receivables turnover. The formula is just trade receivables divided by our credit sales multiplied by 365, since this is in days. So we are given the value for trade receivables right here to be 76,400. Then we just divide it by our credit sales, which is given to be 825,000. And we just multiply it by 365. And this gives a value for our trade receivables turnover to be 33.80, and remember that we need to round it off, so that's just going to be 34 days. Now we move towards figuring out our trade payables turnover. The formula is trade payables divided by our credit purchases times 365. Okay, we were given the value for trade payables right here, that's 32,900. Then we divide it by the credit purchases, which we were given to be 405,000. And we can just multiply it by 365. And this gives the value for trade payables turnover to be 29.65. Again, we need to round it off, so that is just going to be 30 days. Now we need to figure out our inventory turnover. And the formula for inventory turnover is average inventory divided by cost of sales into 365. Okay, so we already have the value for our closing inventory, but we're not given any information regarding opening inventory. And also remember that we have already calculated the cost of sales to be 429,000, and we're also given purchases, which means that we can calculate the closing inventory using the formula for cost of sales. Let's do that. So our cost of sales is just the opening inventory plus purchases minus the closing inventory. In this case, we have our cost of sales to be 429,000. We're trying to figure out the opening inventory. We're given the purchases to be 405,000, and we're given the closing inventory to be 44,000. So this just gives our opening inventory to have the value of 429,000 minus 405,000 plus 44,000, which results in the value of 68,000. Now we can figure out our average inventory, and the formula for average inventory is just the opening inventory plus closing inventory divided by 2. We have our opening inventory to be 68,000. We are given the closing inventory to be 44,000, and we just divide it by 2. And this gives our average inventory to have the value of 56,000. Alright, now we can figure out our inventory turnover. So that is just going to be 56,000 divided by the cost of sales of 429,000 multiplied by 365. And this results in the value of 47.65. We can just round it off to 48 days. So we have our trade receivables turnover to be 34 days, trade payables turnover to be 30 days, and inventory turnover to be 48 days. Let's write it down. We have trade receivable turnover to be 34 days, inventory turnover to be 48 days, and trade payables turnover to be 30 days. And this gives our working capital cycle to be 52 days. That's all for the first part. Let's move towards the second one. We now need to calculate gearing ratios. And the formula for gearing ratio is just non-current liabilities divided by our capital employed. And capital employed is just the sum of our equity and non-current liabilities. And we have the gearing ratio in terms of percentages, so it's just multiplied by 100%. Okay, so we were given debentures, which will be our non-current liability. Right here, that's of 100,000. And then for equity, we have 300,000 and 30,000 as ordinary share and share premium, and we have already calculated our retained earnings below. So we need to include that as well. And our retained earnings have the value of 254,125. So let's calculate our gearing ratio. We had the non-current liability of 100,000. We had the equity of 300,000 as our ordinary share capital. We had share premium of 30,000. And then we had the retained earnings of 254,125. Then we also need to add the non-current liability, which is of 100,000. And we need to multiply this entire thing by 100%, which gives our gearing ratio to have the value of 14.62%. Alright, that's all for the third part. Let's move towards the fourth one. BPLC, a major competitor, has a working capital cycle which is 5 days shorter than that of ZPLC. So we can see that our working capital cycle is 52 days, and for BPLC that's 5 days shorter, which means that that's going to be 47 days. Okay, now for the fourth part, we need to advise the directors of ZPLC whether or not they should be concerned about the company's working capital cycle. We need to justify our answer. And this is a 5 marks, which means that we should have 4 justifications and 1 decision. So since we know that our working capital cycle is 5 days longer than that of BPLC, we also understand that it takes a longer time for ZPLC to convert its working capital into cash. Let's write it down. ZPLC takes longer time to convert its working capital into cash. And if we take a look above, we can see that our inventory turnover is 48 days, right, which is greater than our working capital of BPLC itself. So we can just see that ZPLC is holding too much inventory, which takes greater amount of days for it to be transformed into cash. Let's write it down. So ZPLC holds too much inventory. Now we can also say that comparison is only going to be valid if they have same policies. So we can just consider that BPLC and ZPLC might have different policies. And we can also see that ratios will not consider any of the non-financial factors which might impact the financial statements. So we can consider those factors as well. There may be non-financial factors that impact the financial statements. Alright, now we need to advise the directors on whether or not they should be concerned about the company's working capital cycle. So if we have a look above, we can see that our trade receivable turnover is greater than the trade payable turnover. So this just means that we are paying to the suppliers way earlier, that's in 30 days, than what we receive from our credit customers, that's within 34 days. So due to this reason, we can just say that ZPLC should be concerned because they have very poor credit control as well as they're paying the payables too early. So they should definitely be concerned about the working capital cycle of the company. I'm just going to write that down, decision clearly. So the directors of ZPLC should be concerned about the company's working capital cycle because they have poor credit control and they pay payables too early, because we prefer our trade receivable turnovers to be lower than that of trade payable turnovers. Alright, that concludes the fourth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.